Hi friends, Simit here from InformedTrades.com. On the screen right now, you're seeing a daily chart of the 30-year US Treasury bonds as expressed by the ETF TLT. So TLT is an ETF tracking a 20-plus year US Treasury bond, So long-dated Treasury bonds. This is a daily chart. You can see that prices recently, on Thursday, tested resistance at this horizontal level, which is a significant level going back to October of 2014. We saw it established here. We saw the market pivot off it again at the end of the year, December of 2014. Again here, March of 2015. So a pretty significant level. You can even argue it rallied into here and then declined at the end of May. So this could be another directional turn. We've rallied into it. We have one down day. We also have the moving averages crossing over. We have the 50 moving average crossing above the 200, which some may interpret as a bullish sign, but I think the other signs are a bit more relevant here, the bearish signs. And those bearish signs are, we're rallying into that resistance level. We also have a series of lower highs progressing starting here in January 2015, and then this point here, lower highs in place, a declining trend line. If we look at the weekly chart, we can also get a little different perspective, cleaner perspective. And we talked about this before, the AB equals CD pattern on TLT. Point A here, the high reached in January. Point B, a swing low at the end of July, or excuse me, the start of July. And then point C, the swing high here at around the end of August. So A, B, C, and now that we're touching resistance, I feel like we're still on track to target point D at 106 at some point in the future. If the time length between C and D is the same as the time length between A and B, that would say that in January to so I would say about 7 months from point C, so 7 months from August, which puts us at March, let's say late March, or sometime in March, late March, we might be around 106. That's sort of the basic idea. We also have Martin Armstrong's economic confidence model suggesting that at the start of October, the US Treasury market will decline, or there'll be a sovereign debt crisis, which presumably would interpret as money leaving the debt markets, the government debt markets. In that case, we could also see a further decline. So in sum, I think this could be an interesting opportunity to try shorting TLT, shorting out this resistance level. Our stop maybe at 125 or so, 126. So risking about 3 points. Well, now we're at 121. We could even risk 4 or 5 points. We could enter at 121, put our stop at 124.50, enter at 121.50. Risk 3 points there. And if we target 106, that gives us a gain of 15 and a half, right? So there's 5-to-1 reward risk setup potential here. Of course, it does require being a bit patient, but that's sort of the way I'm seeing. Of course, there are other ways you could play this in terms of when you can move your stop to de-risk it, taking some off. Maybe when we run to 200 exponential moving average at 115, 116, around there. Just some ideas. But in sum, we are testing resistance, and this could be the start of another move down in U.S. Treasury bonds, especially if one gives credence to Armstrong's economic confidence model. We cover a lot of this in depth. If you have any questions on the specifics I'm going over, check us out at InformedTrades.com. We have a lot of educational articles and videos. You can ask questions there as well. Best of luck in your trading and investing. We'll see you next time. Take care.